Okay, we are live streaming now. Hello and welcome to everybody online. And good morning, good afternoon, good evening. If you could just let us know where you're from, pop your name, pop your location in the chat function. Let us know where you're from. Haven't seen anyone on the chat yet. We've got in the room today, we have Peter Hughes and Rachel Johnson. While we're waiting for everyone to come online, I'm just going to tell you a little bit about Peter and Rachel. North Cyprus we have online. So if I can just get started. So Peter Hughes is chairman of the Risk Accounting Standards Board, RASB, and a visiting fellow and advisory board member of the Durham University Business School's Centre for Banking, Institutions and Development, where he leads research into risk-based accounting methods and systems. And Peter is the author of our book today. And with him, we have Rachel Johnson. Rachel is the global head of risk management and corporate governance, professional insights at the ACCA. Rachel has over 2 decades experience creating thought leadership content on a range of financial topics, including risk management, responsible investing, sustainable finance, regulatory change management, and of course, corporate governance. So I'm very, very happy to see you here and to be with you online today. Just have a look. We've got some people from Botswana. We've got South Africa. We've got, lots from South Africa. So that's fabulous. It must be a good time for South Africans. So welcome everybody. And now that we are just after the hour, perhaps we can kick off and I can ask, and we've got Malawi. I can ask you to start, Peter, and if you can just tell us a little bit about the reason for your book, perhaps some insights that we're not going to get from just reading the book. Thank you.
Okay, well, thank you, Caroline, and I'm grateful to you and the Good Governance Academy for organising and hosting this event. I thought the best way to introduce my book would be to provide an overview in the form of a commentary and illustrate the key points by reading relevant extracts. My book is divided into 4 sections. The first is an introduction. Then I go into operational risk management and then into accounting. And the fourth is titled Next Generation Advanced Measurement Approach, or AMA2, which is where we get into solution mode. So maybe a good place to start is the preface, which amongst a lot of other stuff, explains what motivated me to write this book, which is a point that Caroline just asked me to start with. So reading from the preface, I'm an English chartered accountant. For more than 25 years, I held senior positions in finance, audit, operations, risk management, and treasury and trading in a top-tier global bank. Since leaving JP Morgan Chase in 2003, I've worked in academia and run my own consulting and training business. My work has taken me all over the world. At the last count, I'd worked in more than 50 countries as a banker, consultant, and executive trainer. With all that behind me, I'm now sitting down to write this book, having completely lost faith in my profession. The reason: the accounting profession has ignored the biggest, most dramatic change to the banking sector there has ever been. Big words, but so what was this dramatic change? And I deal with that on page 4. So reading from page 4. In the latter part of the last century, the digital revolution transformed operating infrastructures beyond all recognition, as it spawned globally interconnected electronic banking and trading platforms that in turn facilitated the development and delivery of increasingly sophisticated products and services, fueled by the advent of the derivative transaction. New age technologies enable banks to consolidate their globally distributed technology and operating infrastructures into processing silos that were scaled to support massive growth in production throughput. So just to put that into some context relative to my bank, we had two massive change programs running concurrently, running in parallel. The first was adapting to the, I'm using the word complexification of the global financial system, driven by a surge in investment banking innovation that produced hugely complex derivative, structured, and synthetic products, and equally complex trading structures. The second was the emergence of new age technologies that enabled the migration and consolidation of multiple distributed, autonomous, and these were typically country or legal entity-based technology and operation centers into two global technology hubs, one situated in Brooklyn in the USA, and the other on the south coast of England in Bournemouth in the UK. The combined effect was to create massive concentrations of operational risk in two technology hubs. The implications for risk management were considerable, which I describe on page 75. So reading from page 75, it soon became evident that managing operational risk on such a scale would require substantial new investment. The operational risk management toolkit began to take shape in the form of key risk indicators, or KRIs, risk and control self-assessments, loss event databases, loss distribution analysis, and process mapping. Maybe because of the rush to design and implement the toolkit, or the lack of engagement with accountants and auditors, the rollout of the new risk management functions and their processes was not entirely successful. Such failure and its causes are a primary focus of this book, but here is a summary. There was an absence of coordination and standardization in the approaches to operational risk management, as business lines were left very much to their own devices when developing their programs. Considerable investment was channeled into the so-called advanced measurement approach, a loss distribution analysis method, to estimate exposure to operational risk based on loss history, which could never succeed due to the absence of relevant context information in the form of explicit and dynamic quantification and valid aggregation of accumulating operational risk exposures. Risk and control self-assessment adopted color coding, red, amber, and green, or RAG, as its metric for assessing the probable consequences of suboptimal risk controls, thereby disenabling aggregation and audit of their outputs. Right, so just to recap, operational risks were managed at the granular operating level through color-coded key risk indicators and risk and control self-assessments. The regulatory capital requirement, which was a complete disconnect from the way operational risk was actually managed. So the regulatory capital requirement, designed to buffer any future operational risk losses, was determined through modeling historic loss distributions to deduce current exposures. Together, they constituted a weak and ineffective approach to operational risk management, because color-coded risks are non-aggregatable, non-comparable, non-auditable, and not useful for accountants as a basis for risk-adjusting financial statements, not to mention the inherent subjectivity of risk and control self-assessments. On the regulatory capital side, loss history is not a reliable predictor of the future. Indeed, in 2016, the Basel Committee announced the withdrawal of these approaches as an accepted method of determining regulatory capital requirements, citing the inherent complexity and the lack of comparability arising from a wide range of internal modeling practices. The Basel Committee on Banking Supervision's 2013 post-crisis analysis set out in a paper titled Principles for Effective Risk Data Aggregation and Risk Reporting included severe criticism directed at banks, which I describe on page 17. So returning to the book on page 17, which begins with a quote from that paper. Many banks lacked the ability to aggregate risk exposures and identify concentrations quickly and accurately at the bank group level, across business lines and between legal entities. Some banks were unable to manage their risks properly because of weak risk data aggregation capabilities and risk reporting practices. This had severe consequences to the banks themselves and to the stability of the financial system as a whole, end quote. As an aside, that's pretty heavy stuff. My commentary from the book continues. The Basel Committee's conclusion, however, is focused on symptoms rather than causes. How can it be appropriate to criticize weak risk data aggregation capabilities and risk reporting practices where there is no generally accepted method of quantifying granular operational risk exposures? The Basel Committee must have known that the widely adopted method of identifying operational risks and assessing the effectiveness of their management and mitigation is by color coding them red, amber, or green. Stating the obvious, you can't aggregate colors. It is the absence of operational risk quantification where regulatory criticism should also have been focused. So we're not in a good place. So I guess the natural question to ask after that is, so where did it all go wrong? I offer one possibility on page 20. So reading from page 20 of my book. In the original 2003 version of the Sound Practices paper on the management and supervision of operational risk, the Basel Committee wrote, reflecting the different nature of operational risk for the purposes of this paper, management of operational risk is taken to mean the identification, assessment, underlined, monitoring and control mitigation of risk. This definition contrasts with the one used by the committee in previous risk management papers of the identification, measurement, underlined, monitoring and control of risk. Note the reference to operational risk as being different and the transformation of the word measurement into assessment. The inference is that exposure to operational risk can only be assessed, it can't be measured. This position from the global regulatory standard setter effectively removed the obligation from banks to seek measurement-based methods of managing exposure to this particular risk. So what caused the regulators to, in their paper, to take away the word measurement and replace it with assessment? So here's a bit of an insight. And throughout my book, I've included side panels with anecdotes and some personal observations. And I couldn't resist including this one, which illustrates the bank's lobbying of regulatory authorities at its worst, because it demanded and got the wrong result. So reading from the side panel on page 20, and I'm using fictitious names here. For more than a year, Derek attended the meetings of a Banking Trade Association's advisory panel that was convened to review and comment on the new capital called Basel II. He was a regular attendee and had become accustomed to seeing the same cast of characters from all the major banks who also attended the meetings. On one occasion, he received an email from the association's director overseeing the project. He wrote, "Just to let you know, at our next meeting, the regulators want to consult with the industry on an operational risk paper they want to issue." This was coded language that meant representatives of the National Regulatory Authority wanted to attend the next meeting of the panel. When he arrived at the meeting, Derek walked into a room full of strangers. He quickly identified the regulators. The other strangers were chief risk officers from the big banks. The big guns had been rolled out. Their collective firepower was directed at one word in the paper: measurement. This was lobbying at its most aggressive, with much mid-air finger stabbing as the bankers went on the attack. You don't understand. Operational risk is not like market and credit risk. It's different. You can't measure an operational risk like you can a market or a credit risk. That word measurement has to go. Now, I'll leave Derek's true identity to your imagination and whether this side panel describes fact or fiction. So where are we? The banking sector has built its operational risk management methods and systems for a major risk type on the assumption that it only could be assessed, not managed. And this became the universally adopted mindset, as illustrated in an academic paper I refer to in my book on page 37. So reading from page 37, consider this statement included in a paper published by the Journal of Banking and Finance in 2014, titled Systemic Risk, Governance and Global Financial Stability, written by an eminent group of academics and practitioners, which, just to put it into context, included the former chief economist of the Bank of England, Andy Haldane. And this is the line that just jumped into my face as I read it. A risk is inherently unobservable. Only outcomes are observable. Now, my take on this misguided, if you'll forgive my attitude of superiority here, but my take on this misguided but understandable characterization of risk is set out in the preface to my book. So I'll just read from that. There is a widely held but wrong-headed view that operational risks are inherently unobservable and only outcomes are observable. Accumulating operational risks are unobservable because nobody has insisted accountants should make them observable. Let me explain. Risk in a financial institution is a financial abstraction in the same way that profit or equity are financial abstractions. Making financial abstractions observable so that businesses can measure financial performance and make informed decisions is what accountants do. For example, cost accountants apply their skills to determine a firm's fully loaded cost of manufacturing a product. They gather cost information from across the enterprise, variable costs, fixed costs, overheads, and determine how each step in a product's manufacturing process consumes those costs. The result is unit cost, the fully loaded cost of manufacturing a product. Unit costs provide vital information on the composition of profit margins that are used to calculate product profitability and manage enterprise costs and operating efficiency. In this book, I argue that precisely the same accounting techniques that make the fully loaded manufacturing costs of a product observable can be adapted to make all forms of risk observable. So that's been the focus on operational risk management. So let's now focus on accounting. And on page 7 of my book, I set out the accounting arguments in relation to operational risks. So I'll just read from that. It is an undeniable certainty that a business will create and accept exposure to operational risk to increase shareholders' equity. It follows that if a business accepts an operational risk, it also accepts a probability of loss relative to that risk, which can either be expected or unexpected. An expected loss is where a business accepts exposure to risk that are identified, quantified, and aggregated, and the aggregated amount is within pre-approved operating limits. The aggregate of accepted exposures to risk is then valued according to the quantitatively modeled probability and severity of future losses that aggregated exposures to risk are likely to produce. Sound accounting practice is to charge that amount to the income or profit and loss statement in the form of a provision for expected loss, which can also be termed the cost of risk, thereby reducing shareholders' equity. In accounting, the charge to the income P&L statement is made to the business line that originated the risk so that it can reflect the cost of risk in its product pricing. This is how accounting ensures accountability for incurred costs, including the cost of accepted risks, which also acts as an incentive for more effective risk management and mitigation. In other words, risk management becomes both a risk mitigation and a profit improvement initiative. Accounting for expected loss in this way is consistent with the fundamental accounting principle referred to as the accrual concept, which requires revenue or expense to be recorded when a transaction occurs rather than when payment is received or made. Consequently, accounting for the expected losses associated with the exposures to operational risks triggered by accepted transactions is sound accounting practice that ensures such probable losses are immediately recognized in accounting systems. However, such accounting treatment presupposes exposures to risk can be quantified and valued explicitly and dynamically with reasonable precision. Many will think that cannot be done. It is not possible to quantify an exposure to operational risk. The aim of this book is to demonstrate that it is indeed possible, and it may not be as difficult as people think. So that's the accounting perspective, but let's now go into solution mode. Possibly because of a 25-year corporate career in relatively senior roles at one of the world's largest banks, it's kind of in my DNA that the escalation of an issue must be accompanied by a plan of action. And a plan of action to address the non-aggregatable and non-comparable operational risk management outputs is the implementation of a next generation accounting method and system we call risk accounting. The two fundamental principles of risk accounting are set out on page 29. So reading from the book again. The integrated operational risk management and accounting solution described in section 4, a next generation advanced measurement approach, or AMA2, uses a novel method to quantify and account for exposure to operational risk. The first is that the quantification of non-financial risks requires a non-financial metric. This is a new area of endeavor, and such a metric didn't exist. So one was created and called a risk unit, or RU. The RU is a standardized additive metric that is designed to express all forms of operational risk. The second is that exposure to operational risk is created upon the transfer of products and services to, or the execution of trades with, third-party customers, counterparties, or intermediaries, as this is what sets operating infrastructures and supply chains in motion. So those are the two fundamental principles. But moving on to reporting in risk accounting, which revolves around three core metrics, which I define on page 173, which is the following. The next generation advanced measurement approach we call AMA2 introduces a new metric, the risk unit, or RU, into the AMA2 framework. The RU is a common additive metric that expresses all forms of operational risk and is used to quantify, aggregate, and report exposures to operational risk using three core metrics. The first is inherent risk RUs, which is the amount of operational risk in RUs before considering effects of internal risk mitigation activities and processes, which in turn represents maximum exposure to operational risk. And as an aside, another way to view inherent risk RUs is the daily risk loading on an enterprise's operating environment generated through sales and trades. The second is the Risk Mitigation Index, or RMI, which is a measure of the effectiveness of internal operational risk mitigating activities and processes on a scale of 0 to 100. And the third is residual risk RUs, the amount of operational risk in RUs that remains after reducing inherent risk by the RMI, which represents the actual exposure to operational risk. Later, I observe under the heading key attributes of the risk quantification method, when I make a reference to risk culture, the Risk Mitigation Index, or RMI, is a composite measure of risk culture, as it blends qualitative and quantitative risk attributes from across the enterprise into a single metric. Accordingly, risk governance is focused on planning and implementing strategies aimed at continually improving the RMI. In a longer term view, we look at how a monetary value of an RU can be derived. And this is on page 182. A longer term aim is to calculate and publish the monetary value of an RU by modeling operational risk loss data statistically correlated with additional context information in the form of residual RUs. Once determined, the monetarily valued RU can be used to estimate operational risk-related expected losses. The expected losses calculated in this way can be used to risk adjust audited financial statements. This creates the possibility to lobby regulators to adopt the RU in the determination of regulatory capital requirements for operational risks, providing more effective balancing of risk sensitivity, simplicity, and comparability in capital adequacy calculations. So that's basically what I wanted to introduce from the book in a very high level. I'll just mention section 4, which includes a detailed walkthrough of the 9 steps that comprise the risk accounting method, written in the form of a self-study guide with fully populated tables, templates, and reports. By working through the 9 steps, readers can see all the inputs and rework all the calculations and aggregations relative to 11 sample products of varying complexity taken from both the banking and trading books. I'm not convinced that I should use this book lounge event to describe in detail a next generation accounting method and system. Safe to say that the whole solution from A to Z is described in my book and its appendices. My book also reflects on how the various aspects of risk management will be impacted through the implementation of risk accounting and the adoption of the RU. And they include environment, social governance, ESG risks, climate change, models in bank regulation, artificial intelligence and machine learning, infrastructural transformation, operational resilience, the 3 lines of defense and the role of audit, risk data aggregation and the portfolio review, risk culture, systemic risk and expected losses, risk capital, value at risk or VAR and associated accounting, risk adjusting accounting, accounting measures for operational risk, fintech and the new challenge for accountants, and risk accounting and economic profit. So that's all I have. So thank you for listening to me, and I guess I now pass over to Rachel.
Hi, yes, always great to, thank you for inviting me. First of all, Carolyn, it's always great to work with the Good Governance Academy. We have so many shared interests. And likewise, great to hear Peter talk again about his book, who we're also doing a lot of collaborating with for many of the reasons he's just described. Since I joined ACCA in June 2020, I have been talking with all of our members who work in so many different capacities and roles in terms of managing risk and providing insight to the decision makers about risk. And we've all learned so many lessons. The members talk so much about, even those who had the most mature enterprise-wide risk management frameworks or thought they did, how, as Peter said, the color-coded risks, those are old traditional techniques that just don't work in today's physical world, because those greens, and most of them were people risks, operational risks, non-financial risks, emerging risks, were the ones that actually hit them right between the eyes. So working with RASB and Good Governance Academy and with our respective members to help bridge that disconnect between risk and accounting, to talk about how we can look at what the information we're sitting on, look at what information we need to gather more to help us understand our risks better and actually account for them, not just report about them. So speaking of pages of the book, one that I highlighted this morning was on page 41, where in Peter's book, if you haven't got it yet, he talks about, many times throughout the book, about not making the same mistakes that we've made before. And let's face it, all of us who are our age have lived through quite a few crises, and every time accountancy, and I can say that since I work for the accountancy profession, have been part of the problem or at the core of it. And we're not dealing with just physical risks and credit risks. We're dealing with intangible risks. We're dealing with existential risks. We're dealing with people. We read the newspapers every day, and we can see that people are the ones driving the risks, and we just don't understand them. We don't know, and as Peter says, they're accumulating. So on page 41, Peter does talk about there's an obvious concern that adopting similar model-based approaches to valuing ESG risks may repeat the same mistakes of the past that left banks, boards, and C-suites executives with a hopelessly inadequate toolkit for managing exposure to operational risks. And he goes on again about the standards, the regulations, the way that our lenses were, and the way we detected with colors and risk registers. And I saw really interestingly in the polls that 29% of you said the whole organization is risk aware. I wonder how you think you know that. Or the 25% who said, I don't think we manage risk at all. And that is all about communicating and collaborating, understanding, working together, what you guys can pull together to detect, plan for, and embed all of this into your decision making. So I was telling Carolyn earlier that with my engagement with members, I've talked to organizations and including banks, and that's where this is really interesting, where we'll have ACCA members who are both the CRO and the CFO. And until the first lockdown, they never even traded notes or looked at each other's scenarios. They were both running completely different types of scenarios and not combining that information to make better decisions or to think about what metrics they need to look at in order to make sense of what might be happening, or give them, most importantly, some foresight to plan for that and understand what their material risks are and what those losses could be, so they could plan for. So I think, we're in a new era now with risk and accounting and how we account for risk. And I think accountancy professionals, we need to get out of the back office and move more to the front line and work with the risk managers more and work out what information do we have that we can utilize more, and what information do we need to get? What questions do we need to ask? There are going to be a lot of uncomfortable questions when we're dealing with the risks that we are today, the geopolitical risks, the ESG risks, and they're all interconnected, which we have learned so hard over the last couple of years. And I think that sorry, I lost my train of thought. Yeah, I think that working together to build these models and understand how we adapt them and how we work with them to not just plug something in and say, okay, we've got it done now. It's about how we're constantly monitoring them, evaluating them, and working out how we can improve them. We talked earlier about, before we went live, about carbon accounting and again, trying to put a price on these intangibles. And we can think back to a couple decades ago when we were trying to calculate the number of carbohydrates in a can of Coke, and you can bet your money that we didn't have the exact the 100% accurate number on them at the time, and now we do. And we need to look at that with some of these intangibles. We need to get on the wheel, and we need to keep going at it until we get it right. All these models are going to be littered with assumptions, but we need to constantly be monitoring what we're putting in and what we're getting out. And this is something with, like, again, with scenario analysis, that we could be optimizing more to get a bigger picture of what our risks are and plan better for them. So I'm really looking forward to collaborating with Peter. If you look on RASB's website, there's a video I think he's put up, but there's definitely a note about what we're working on with Premia to try to get risk professionals and accountancy professionals to work together more to understand. We're also working a lot with the Good Governance Academy about looking at risk more as a value creator, and how we as accountancy professionals in any capacity that we're working on finance teams, audit, how we can not just define the purpose, help our organizations define purpose, and think again about what value is and what our role in society is, our purpose in society, but most importantly is activate it and verify it. So I'll end on this in referring back to page 41 in Peter's book, is that from the accountancy professional too, with my member engagement, I'm very frustrated with how we're all approaching ESG. Of course, we need to report on it. We need to be transparent. That is absolutely so important to inform our stakeholders. But the problem I have is when I speak to a lot of our heads of internal audit around the world, some household name companies, household names that confide in me that when they're doing their work, they can't verify or find evidence of as much as 90% of what is put into those statements. So we have a lot of work to do, a lot of collaborating to do, and a lot to learn together in this crazy world that we live in. So I'll end on that note.
Thank you. Thank you, Rachel. I mean, so much knowledge and value added. Thank you so much for both of you. I've got a couple of questions, but first of all, in the Q&A, just a reminder from Paul String, what is RU, Peter? What does RU stand for?
Well, that's the metric. So we quantify an organization's exposure to risk in RUs. So it's a non-financial standardized unit of measurement that measures non-financial risk.
Thank you.
So, if we're talking about monetary values, so if we're talking about financial risk, credit risk and market risk, we have a natural unit of measurement, which is natural currency. If we're looking at non-financial risk, you can't measure a non-financial risk with a financial metric. So when we put this methodology together, we said if you have a non-financial risk and you want to quantify it, you've got to have a non-financial metric. There wasn't one, so we created one. So we created the RU.
Thank you, Peter. So yes, Paul, it's a new term, clearly, and it comes out of the book. Thank you, Peter. I see one here from Kuni around the evolution of sustainability-linked financial instruments. Perhaps, Kuni, you would like to actually ask your question yourself. I'm going to just raise you up to ask the question. But in the meantime, I've got a question back to Rachel. You said that accountants are part of the problem. Can you just expand on that a little bit more, please?
Well, I think there's a few things that's happening right now. And the great thing that I love about my job is the debate and the member engagement where people do open up and talk about this and admit this. And particularly from the banks, as Peter says, is they say we have been part of the problem. Accountants always want everything to be an exact number. And if it's not, they shy away. So I think right now what we're dealing with is there's a lot of fear about getting it wrong when it comes to pricing all these different intangibles. And that's what we're trying to talk about, is setting up, looking at the information that we're not using and connecting the dots. And as Peter says, we're dealing with models that were created for the physical world. And most of the risks that hit everyone between the eyes, as I said earlier, were the intangible risks, the operational risks. And the longer we don't understand them, the harder they're going to hit in the future. So we need to really, we need to look at these inputs. We need to look at the outputs of our scenario analysis. We need to not just look at our risk because we have to report on it and then think, okay, we know our risk because we complied with that reporting requirement. We need to dig a lot deeper and ask ourselves questions what information we don't have and how do we get that. And as I said, what I'm learning is a lot of the disconnect across business units and even within the C-suite, and definitely between the boards and the C-suite, is just not asking each other the questions and getting the answers to it. And that kind of risk monitoring is ongoing. I saw on one of your questions about, assessing risk annually. You can't assess risk annually. You can't even do it daily. It needs to be something that's an ongoing conversation. And we're talking about, not just top down, which is so important because the boards do need to set the tone and make sure that the finance teams are, they need to ask for this information. They need to ensure that these appropriate internal controls are there to verify those disclosures. For example, they need to make sure all these questions are asked, and we can get into that, the role of audit committees and so on in this respect, but it also needs to be bottom up. And that's what we're talking about with risk culture. And I'd love for any of those 29% who said that they think that their whole organization is risk aware to explain how they know that. I'm really fascinated about human behavior and how we measure it, and we can measure it. People in ACCA sometimes say, really, how do you do that? Well, there's a lot of ways to measure it. And I've been set up a special interest group on this. And it's fascinating to look at how people just, fire their imagination to ask the questions that they need to in order to measure this. And there are a lot of old tools and frameworks that we can use to adapt to today's age as well.
Thank you, Rachel. I see Kuni is online, and you can ask your question because we are going to come back to that audit and risk question.
Hi, Karen, and hi, Rachel. Thanks, and Peter, thank you so much for the opportunity and for the effort to put in for this. My question goes back to ESG-linked financial instruments, and we see such a divergence in the treatment of products. And as accountants, we often point to, the IASB, SASB for the lack of guidance on treatments. And you spoke quite openly about, setting up working groups across banks to discuss such information. And I always thought there were such heavy restrictions on the information we share across this. Are there forums of banks doing this? I mean, I'm aware of UK Finance because I do a bit on the impairments provisioning and the comparisons between models. But, even on that forum, the amount of information we share across each other is very limited.
Are you looking for information about how to price them, or are you looking for information about what types are out there? What exactly, or just knowledge about what your peers are doing? What exactly?
Yeah, so I think something along the lines of a standardized approach. If we're all using the same models to value our carbon credits, whether we're using it to either sell on to our customers from a bank point of view, or to utilize as an organization, that sort of guidance that comes out, that is shared. Different banks have different approaches to how they hold their carbon credits, whether they're using it to sell on or to utilize for their own carbon footprint.
I mean, I'll say my 2 cents first, then Peter can give his. I mean, you're right. There's an alphabet soup of standards, which is one of the reasons why I'm excited to work with Peter and RASB and Premia on trying to provide a more guidance, a useful technique, a framework. I think a lot of the CROs who I speak to, particularly in the financial services, they are using various different frameworks and then trying to combine the best bits of those to understand, things like their carbon footprint and so on. I think from a finance and financial product point of view, it is exciting, and it's happening all over the world. And I can send you in the chat link while Peter talks just a few websites to look at. There's a lot that Institute of Risk Management is doing on climate risk. We have partnered with them before on forums like this to talk about it, and they just released a report at the end of last year called Climate Wise, which I'll put in the chat box, and a few other things which I hope helps you because it's such a broad topic.
Thank you, Rachel, and thank you, Chikuni, for your question. This all sounds very technical for me as a non-accountant. My question is to you, Peter. So even as you were talking, it sounded quite technical. Who have you written the book for? Who is your primary audience in this book?
Well, on the cover, it says a guide for risk managers and accountants. I think that's basically where it's directed towards. And if we look at accounting, it's really in the management and cost accounting area. It's been, if you look over the history of this whole risk, risk reporting, risk accounting, it's fraught with disasters. And it started in 1988 when the Basel Committee first set up its, the first capital standard, where it created its own metric called the risk-weighted asset, the RWA. So back in 1988, the global standard setter for the banking sector basically divorced itself from accounting by creating its own metric and its own standards for that metric. So we've had decades and decades of accounting being in isolation relative to risk. So somehow that gap now has to be closed, because as we saw with climate change appears on the horizon, it affects corporates, but there is no mechanism for them to absorb this new risk type and actively report it. And we're focused on climate change because of the threat and the crisis, but there's cyber risk, there's conduct risk, there's fraud risk, there's all kinds of risk that are not being dealt with in accounting terms. So I think a massive job needs to be done to factor risk into accounting. I think that really there is a great need for that. Otherwise, the relevance of accounting is threatened, because if you publish a set of financial statements which only reports outcomes, so resolved historic outcomes, that's what accounting does, without considering the probability and severity of future events that could impact financial performance and condition, you're not giving stakeholders in that organization the full picture. And investors, certainly the investor community, is standing up and saying, we have no confidence in accounting, so forget reporting accounting profitability. It doesn't mean that much to us. We want sustainability. We want to know a corporation's sustainability. So in my simple accountant's brain, if you want sustainability, you've got to blend the historic performance and financial performance and condition with what is likely to happen in the future. And as Rachel said, accountants are sitting on a phenomenally powerful set of information. I mean, in accounting records, you have every contract, whether it's to buy a box of pencils or to build a bridge. Every contract is recorded in accounting systems and the receipts and expenses that emanate from them. Now, I don't think it's necessarily rocket science to look at that resource and say, right, we know that we understand the financial aspects of that because we've dealt with it for millennia, literally millennia. Is it so difficult to say, look at your risk register and start thinking in accounting terms? Here's my risk register. Here are all the contracts in my general ledger that I've accounted for all these contractual obligations. Is it beyond the wit of people to put that together and come up with an accounting solution that blends the historic with the future in a single report, which then you can label sustainability because you've accounted for the future? So to come back to your original point, Carolyn, this is focused on in the first instance, CFOs and CROs. And what is exciting about working with the ACCA is that they have access to CROs and CFOs and can bring them together. And what Rachel is telling us is that she's having some success. You know, there's some resonance there.
Well, that's my question. Sorry.
Yeah. No,
sorry to interrupt. Okay. You said if they have the wit. So my question to Rachel, you're in the front line now. Can we teach old dogs new tricks?
Good one. I mean, I think in terms of everything that we've been saying, and so that I don't repeat myself, you know, when we look at these frameworks and what Keaney rightly pointed out is, you know, what are these? What do we need to look at when in sustainable finance? Well, we need to, again, it's about asking questions, you know, looking at the reporting frameworks and thinking, okay, well, this is how I know my risk. It isn't. That's just like being compliant. We've got to take a step back and think about, well, what are the purpose of these frameworks? You know, you could talk about this for us and enlighten us about ISO 37000, since you were helping, you know, one of the main drafters for it. You know, how do we look at something like that and think, well, what is our objective here? What is our purpose? And I think that's where we got lost in the accountancy a long time ago, is just looking at these and not thinking about the actual information that we're gathering and why we're gathering it and what it can do for us. And again, once we account for the risk, that's so important, but that's also, once we account for it, we can plan better. And we can look at long-term performance and consider those environmental and social matters that are relevant to our organization. There isn't the problem I have too with all of the different frameworks and the way that organizations around the world look at them. There is no one size fits all. And the standard setters will say that, definitely. But the organizations, there's this massive gap in terms of guidance and you know, what's being said and what's being put in practice. And that's what we have to think about. And we have to really, it just boils down to good old fundamental analysis in terms of your old dog tricks, is just, you know, not reinventing some kind of new term or anything for it is so much as just really going back into the old fashioned analysis and asking questions. You know, think about it in your own household. You know, how can I reduce plastic, and what are the long-term consequences to us not recycling or not buying plastic or buying plastic. Sorry, I'm getting a little bit lost in my words, but I hope that makes sense.
Absolutely. And thank you for that. And I think to Peter, as we kind of come to a conclusion, but most of, and dare I say it again, most of these old dogs are sitting on the audit committee and sitting on the risk committee and the board. These are the retired audit partners, etc. So to Peter, what is your primary message to the audit and risk committees out there and the boards of directors around all of this that you're saying?
Well, I think the first message is to start to believe that what you thought was unobservable is observable. I think that belief has to, because I would imagine that the most frightening place to be, if you're a CFO, a CEO, a board, an audit committee, is the threat of unexpected loss. Now, if your accounting does nothing with respect to accounting for risk, that threat of unexpected loss is there. And the biggest example is the global financial crisis, where towards the end of 2006, banks were reporting fabulous profits off the back of subprime, and then they started failing serially. And how does a CFO or a board, well, CFO, how does he go to the public and say, we didn't see these risks coming, we just didn't see them? And then you look at the risk reporting they're getting, it's all traffic lights. So I think there has to be, the message is that boards can only function effectively through numbers, not colours. And if we put out this hope that there is a way of achieving that, then engage with us and let's do some proofs of concept. Let's try it out. Let's experiment with it. Let's have a look at the outputs and see whether that can be done, you know, translating risk reporting from traffic lights into hard numbers.
Thank you, Peter. David's last question. David's got a question specifically around what needs to change. David, would you like to ask your question?
Thank you. Thank you so much. So Rachel and Peter, just really great discussion. And I've been in the game for a long time. I'm a chartered accountant and I share your frustrations. I'm in the investment world at the moment. But the reality is we are where we are because of the way the global financial system works and the power of certain role players in that system. So the question I want to ask you is, well, let's go back a bit. I mean, you're doing some great work and there is the risk that your framework and your work might be ignored going forward, however beneficial it could be. So what has to change and where is the leverage to help bring about that change?
Could I just go with that? I think we saw with Basel III, you know, the post-crisis rules, there was just a massive ramping up of protective op-risk capital, which must be phenomenally costly for banks to maintain. You know, inert, unproductive capital just sitting on the balance sheet, because that's what the regulators have mandated off the back of a global financial crisis and the huge cost that's associated with that. So I think if there's any incentive for, you know, particularly banks, okay, at least banks have that capital. There are a lot of other industries that don't have that kind of capital. And then, you know, their losses are basically underwritten by the taxpayer if it's a critical industry. But I'm sure that you could build a very powerful argument to say that capital requirements have been ramped up to eye-watering levels at huge cost. That cost is just sitting there, not being accounted for. You can come up with an accounting solution which will effectively mitigate that cost and that amount of capital and provide you with the basis to begin lobbying the authorities to say, we have a real risk and accounting system that can more effectively identify, quantify, aggregate, and report those risks. And I think that's, to my mind, that's a very compelling argument.
Yeah, I'd agree, Peter, but it needs to move right across all industries, not just the banking industry.
Well, I think this is, and I'm sure Rachel can add some words on that. I think, I mean, I'm a banker. That's my industry. That's where I've spent, you know, 25, 30 years of my professional life. But one of the big challenges we have, and particularly working with the ACCA and Premier, is, you know, can what we have developed for banks, is it transportable to other industries? That's something that needs to be examined, tested, validated, and that's why, you know, the contact through the ACCA is potentially very valuable in this context.
Yeah, exactly. I mean, the colors, your colors problem runs across the industries, including MBA charts, you know, 4 quadrants, and you know how those are put together. Okay, thank you so much.
Thank you, David. Rachel, I'm sure you're doing some work on that in cross sectors, right?
Yes, I mean, definitely. And throughout the early stages of the pandemic, when I first joined the ACCA, I talked to a lot of corporates, large and small, and in all hemispheres, about how they can utilize and apply more bank techniques. And, you know, they wanted to learn about value at risk and so on. But I think that again, it's just understanding, like I said earlier, the purpose of them and how it does apply. You know, look at the headlines today. We're looking at geopolitical risks that you know, we knew the Ukraine crisis this didn't come out of the blue. This is something that we've known, and you know, let alone policymakers have known about with their intelligence. But you know, companies have known, and you know, you look at like the BPs and the other ones, companies trying to pull out. Well, they they would have understood, would have known these risks. And I don't know if really what a bank was doing would be able to, help them have planned better for that. These are things that they knew about, that they could have planned better for. Again, I think it's stuff that they should have been talking about at the top. We're seeing some of the oil companies creating geopolitical board committees now, and in fact, and at least BP has in the last couple of weeks. But it's never too late. But I mean, come on, that was something that should have been talked about. But I guess my answer is yes, we are looking at this all the time, and this, these collaborations like with Peter's to pull our members together, to empower them to talk about how we do this. We have CFO and CRO forums. Peter's talking to our next CRO forum, and it will in April about this, and this is what days like this are all about, to try to share knowledge and work to see how we can do that. I do know that some of the best risk management teams that I've talked to in the world are the ones that are using a bit of everything. There are some insurance companies that are helping too, like there different sectors, and pharmaceutical companies, with their due diligence, helping their value chains and supply chains. Tesco, for example, here in the UK is a really great example. We have quite a lot of fellow ACCA members in the Treasury Department, including the one who is head of risk management, and they have put together a new sustainable finance program that they implemented right away. They were already working on before the first lockdown, and they're helping to not only pull their SMEs down excuse the pun, the food chain, but to help them pull them out of the debt and deal with the supply chain crisis that wasn't just about the pandemic, but Brexit as well, and do that while considering more environmental and social matters in doing that, and asking those questions and collaborating more. And if you do ask Alex Ashby, is the guy who spearheaded that, he will tell you that the secret to their success is asking questions. What data do we need? What data don't we have? What do we have? How can we? What are the metrics that we need to pull together here to help us understand what the risks are down the chain?
Thank you, Rachel. We have come out of finished our time now, our allotted time. I'm just asked one last question in terms of we're assuming that we've got CFOs and CROs, but how many of those organizations really do have CROs? Is it a dedicated role, or is it some other executive that's responsible for risk, or is there no risk officer in the organization altogether? I'm just going to give it another couple of seconds because I know we're out of time. But just to say thank you very much, Peter. Thank you for writing the book. Thank you for bringing it to our attention. And Rachel, thank you so much for your collaboration with the Good Governance Academy and for your work behind this. It truly is a very impressive work that you're doing. And I'm really glad to see that we are on getting on top of this. And it's not just the banking side. So I have a look at the results. I mean, we've got 29% who actually don't have chief risk officers, 29%, 30% again, with it's another executive possibly not dedicated to risk, and we have a 42% then are saying yes. So thank you very much to everybody. Really do appreciate your time, and this will be put on live, and anyone who requested a certificate of attendance, they will be sent out in the next few days. Thank you very much, everybody, and have a good rest of the day.
Thank you very much.
Thank you so much.